Right. With the first pitch of our 2021 fall semester. Before I get started with the pitches, I want to introduce you guys to some exciting news. As you know that we have consolidated our Tampa and S&P funds this year. Our combined value is currently surpassing $1.6 million with over 30 students in total. This is very exciting, as you know that we started with $40,000 in Tampa in the first year, and overall in the past over the first 5 years, we had about $250,000. So the Tampa fund has grown from a $250,000 to $1 million, and the S&P fund is at $600,000 now. And I want to introduce you to our bright students this year, the new faces we see every year, but the same intellectual level, if not better. And I keep getting challenged by these students. And I see many familiar faces from our alumni network as well. Welcome, Clinton. Welcome, everyone. So it's really good to see everybody. And we will alternate our pitches between Tampa and S&P campus in the future. So we will join our S&P Merrill Lynch Wealth Management Center as our pitch location in the future as well. Without further ado, let me introduce you to the first group, Oshkosh. We'll have 2 buy pitches and 1 sell pitch today. Please.
Hello everyone, ladies and gentlemen of the board, Dr. Chen, thank you so much for joining us today. I'm Omar, along Carlos and Zoran will be presenting of what we believe is a great investment opportunity to our fund, Oshkosh Corporation. Giving you some key metrics about Oshkosh Corporation, they operate in the industrial sector, specifically the farm and heavy construction machinery. Their market cap lies around $6.95 billion, and their PE is trading at 14.5. Giving you some more information about their stock price, their last closed stock price of yesterday was $101. Through our valuation, we reached an implied return of 36.6%, leaving our target price at $138. If you take a look at the chart on the left, we can notice that the stock observed a major sell-off in June. That was due to rising concerns about supply chain issues. We believe that the stock was oversold and the current price is a great investment opportunity. Talking more about the company, Oshkosh is a leading manufacturer and designer of specialty vehicles and equipments. The company operates through 11 brands and discloses its revenue through these 4 segments: access equipment, defense, fire emergency, and commercial. Giving a quick overview over each segment, the access equipments, where they are a leader manufacturer and designer of aerial platforms, telehandlers, hydraulic lifters, as well as towing trucks. Their main customer base here is the construction industry, as well as towing company. For the defense segment, they are a leading manufacturer and designer of light, medium, and heavy military tactical vehicles. Their main customer base here is the US government through the Department of Defense and the US Army. Moving on to the fire and emergency, where they produce fire trucks, snow removal trucks, and specialty firefighting trucks for airports. Their main customer base here is municipalities as well as private airports. Moving on to their commercial, where they primarily produce cement mixers as well as refuse collectors, where their target customers lie in the construction industry. As you can take a look here where we break down our revenue, the upper 50% of the revenue stream lies within the access equipment and the commercial segment. The other half lies within the defense and the fire and emergency. As we talked about before, the first half of their revenue stream comes from the construction industry, which can be a slightly cyclical market. However, the other 50% of their revenue stream, which comes from the defense and fire emergency, is related to the US government, providing a steady stream of income to mitigate the risks from the first one. So you ask us, why buy Oshkosh? Firstly, we believe they have a diversified and integrated business model, where they are able to integrate their technologies across all the segments they operate in. Secondly, Oshkosh has a strong backlog and demand. Coming from the revenue, they were affected by COVID-19 as the majority of the economy. they have been showing strong backlog and demand over the past quarters, suggesting that they are on the right track to recovering from their pandemic lows. Thirdly, we'll talk about their well-established history of contracts and awards. We will get deeper into that in our later sections, but I just want you to note that the Oshkosh currently has a 90-plus year relationship with the US government, allowing it to leverage win new contracts. Lastly, we're going to talk about their financial health. They have a strong balance sheet, they have good cash flow generations to cover short-term and long-term obligations, allowing it to invest more in the future. Getting deeper into our first point, the integrated technologies across segments. Oshkosh currently has more than 1,000 patents ready for use. They are able, through their vertical integration and their strategies, to implement these patents and technologies across several segments, giving them competitive advantage within the whole industry. Giving a brief example about this is their TAC 4 suspension system. This suspension system was primarily produced for the defense segment at first, but Oshkosh realized that they can use it within the fire and emergency, allowing them to have a better competitive advantage within that industry, securing more contracts and more revenue. Talking about the company's strategic mission, one of their strategic missions is to acquire new businesses, of course. Talking about their most recent acquisition in January of this year is Pratt Miller Defense. The acquisition was lying around $120 million. Looking at this number, this is not a big number for Oshkosh since they are in this size. However, they are able right now to integrate engineering expertise and innovative technologies within their existing contracts within Oshkosh, as well as Pratt Miller currently working with Oshkosh Defense to produce the uncrewed Stryker tanker for the Department of Defense. Getting deeper into their backlog, I'll leave you with Carlos.
Thank you so much, Omar. Yeah, so the second point that we would like to share with you in regards to Oshkosh is their backlog. As you can see from the chart here in their left, their backlog has been constantly growing since 2016 at a CAGR of 15%. And in the third quarter of 2021, it reached a record of 6.86 billion. This is very reassuring to know, given Oshkosh is still recovering from the effects of the pandemic while also facing supply chain issues, because such a high level backlog shows that the demand across their segments is recovering, and also this long-term trend of growth in the backlog also signals that Oshkosh has a strong market position in the segments that they operate, as well as they have a reputation to manufacture and sell quality products with top performance and manufacturing. Moving on to the next point here in our rationale is favorable industry trends. Oshkosh, as Omar previously mentioned, 50% of their revenue comes from the access equipment and the commercial segment, which they mainly serve companies in the construction segment, which is a cyclical industry. As you all know, with the pandemic last year, the construction industry, with the recent lockdowns that we experienced earlier that year, it declined 2.4% in 2020, and so as the results from Oshkosh. The access equipment, which is their largest division, declined revenues by 38% on a year-over-year basis, and the commercial segment 6.3%. However, things are changing. As you can see from the chart, in 2021, the growth forecast for the construction industry is to be 5.7%, and then at a CAGR of 3.7% until 2025. Oshkosh is already experiencing a growth within their access equipment and commercial segment, as they saw a 213% increase in backlog in the third quarter and a 73% increase in backlog in the commercial segment in the third quarter. The next point here is about Oshkosh's established history of getting contracts with the US government. As Omar previously mentioned in our thesis, they have a 90-plus year relationship with the US government, and we believe they were able to maintain this relationship by adjusting and serving to the needs of the US government while also implementing the best technology around. We found a data from the United States Government Accountability Office that shows that between 2015 and 2020, Oshkosh was able to secure 66% of the total expected value of tactical wheeled contracts for the US Army, which has a total value of 27 billion. This serves to show their dominance in the defense segment and as well as in the fire and emergency with the municipalities. So now that I give you a little bit of the background on their history, right, on getting those contracts, we would like to share with you some of the existing contracts that they're working on. The first being the Department of Defense JLTV contract. This is a 10-year contract with the Department of Defense to build the Joint Light Tactical Vehicles, and it expires in 2025. It currently has a value of 6.7 billion, and Oshkosh is expected to deliver 23,000 units. This used to be 16,000, but in 2019, the US Army increased the ceiling so that Oshkosh could manufacture more. An important thing from this contract is that the US already decided to do a follow-on contract. However, they will decide who is going to be awarded to an open and full competition that will be awarded in the fourth quarter of 2022. It is not a guarantee that Oshkosh will win this contract, but we believe that given their established relationship with the DoD and the existing expertise with the JLTV manufacturing, they have a high chance of securing this contract, and this could be a huge catalyst for them, given this is going to be a 20-year contract with a total expected value of $30 billion. Oshkosh is also engaged in the manufacturing of medium tactical vehicles. They currently have a 5-year contract with the Department of Defense with a total value of 467 million. Moving on here, we would like to talk to you about some of the contracts they have been awarded in 2021. As I mentioned before, they're still in recovery mode. They're still going to supply chain issues, but even still, they were able to secure promising contracts this year. Some of you may already heard of, but in February, the USPS awarded Oshkosh with a 10-year contract to manufacture and design the next generation delivery vehicles for them. This is going to be a contract with a total estimated value of $6 billion, and they're estimated to deliver 50,000 to 165,000 units. The Oshkosh as well has an agreement with the Department of Defense to improve the weapon system for the US Army Striker, which Omar mentioned that they are partnering with their acquisition on Pratt Miller to develop an uncrewed Army Striker, and they have a 6-year contract with a total value of 943 million. Basically, just to wrap it up here, as you can see, Oshkosh has a proven history of securing contracts. They have a 90-plus-year relationship, and we believe that this is a combination of two things, right? Their ability to serve the needs and to deliver the best specialty vehicles for the government, and also their ability to integrate their patented technologies, providing a competitive advantage. We believe that these two factors will help them securing more contracts in the future and thus aiding to their growth. I will pass now to Zoran to continue with the presentation. Thank you.
Thank you, Carlos. So now, moving on to Oshkosh's electrification initiatives. As we all know, under the Biden administration, the U.S. government is pushing for vehicle electrification to assist with the pursuit in reaching a zero carbon emission economy within the near future. Oshkosh is responding well to this increasing demand through its significant progress in specialty vehicle electrification, and we believe that these initiatives could solidify Oshkosh's strong market position and help them win future contracts. So one example of one of their electrification initiatives is the Pierce Volterra pumper, which is the first fully electric fire truck in North America and has already recently been implemented in Madison, Wisconsin, and has already taken over hundreds of calls. Another initiative is the hybrid Stryker Volterra aircraft rescue firefighting vehicle, which mainly serves Oshkosh's airport customer base. And then lastly, going back to the USPS contract, Oshkosh is currently developing the first fully electric mail delivery vehicle and estimates that a minimum of 10% of the fleet that will be manufactured will be fully electric. So we believe that these strong initiatives, they support Oshkosh's strong integration of their innovative technologies throughout all of their segments, which further adds to their diversified business model. So now I'll be going over the strong balance sheet. So as we can see with the chart here on the left, representing Oshkosh's net debt to EBITDA ratios for the last 5 years, Oshkosh has been able to maintain very low net debt to EBITDA ratios, and there has been a downward trend, indicating that Oshkosh is reducing its debt in relation to its EBITDA. So for fiscal year 2020, there was a 0.41 net debt to EBITDA ratio, which is remarkably low and indicates that Oshkosh is managing its debt very efficiently, and also indicates that its strong cash flow generation enables Oshkosh to not rely so much on external financing for acquisitions and larger purchases. Its strong cash flow generation also helps Oshkosh maintain robust liquidity for its short-term obligations. As you can see with the current ratio of 2.23 and the interest coverage ratio of 10.03, Oshkosh has also been able to maintain very low debt to capital of 0.20, which is currently 85% below the industry average of 0.37. This indicates that Oshkosh is currently outperforming its competitors in terms of debt management. So now moving on to the risks. There are three main risks that Oshkosh is currently facing. There's the supply chain issues and rising material costs, the dependency on government contracts, and competition. So going further in depth on the supply chain issues, Oshkosh, along with the broader market in general, has been facing production and shipping delays, as well as rising material and freight costs. And this has impacted margins. However, for the last few months, Oshkosh has been implementing price increases for its products to offset these higher costs and improve their margins. We also believe that the recent growth in demand due to the company's strong backlog also indicates that the company is well positioned to achieve future revenue growth as these supply chain issues begin to dissipate. So now moving on to the dependency on government contracts. For fiscal year 2020, 35% of Oshkosh's net sales were attributed to the U.S. government. Quick note, however, other than the U.S. government, no other source accounted for more than 10% of Oshkosh's total revenues. And this indicates that Oshkosh, for the rest of its business, is well diversified. But however, Oshkosh still does need to compete with other competitors for securing contracts from the government due to the Weapons System Acquisition Reform Act and the Competing and Contracting Act. These acts both require the U.S. government to issue competition for its contracts. And then lastly, going into competition, Oshkosh does not have a single direct competitor due to its widespread diversification, but within each segment, it has widespread competition ranging from smaller manufacturers to larger, more mass-producing manufacturers. So if Oshkosh is not able to maintain its high product quality and remain innovative, it could potentially lose business to these competitors. And then lastly, going into our valuation. So as you can see with the price target pie chart on the left, we allocated 70% of our 2-year target price calculation to the value that we extracted from the DCF model, because we believe that the DCF better extracts the company's true intrinsic value, but we still included the EV EBITDA and EV revenue calculations and gave them a 30% weight overall. And this led us to a target price of $138.23. And now looking at the upside and downside potential. So for the downside, for our bull case, we arrived at a target price, a 2-year target price of $118.38. This is assuming that supply chain issues extend further than anticipated and that Oshkosh is not able to reach the full potential of its contracts. However, on the upside, for our bull case, we arrived at a target price of $153.95. And this is assuming that supply chain issues dissipate faster than expected and that Oshkosh is able to reach its full potential for its USPS contract as well as other existing contracts, and also win new contracts in the future. So to summarize, we know that Oshkosh is still recovering from the pandemic and they're also facing supply chain issues, but we believe due to all the growth prospects that we just explained, that Oshkosh's sell-off for the last few months is over-exaggerated and that the current price presents a strong buying opportunity. Thank you all so much for listening. Now we are going into the Q&A segment.
Question here, guys. Carlton, the biggest hit, and I guess you would say it was pandemic induced, but both 2019 and 2020 was in what you call the access equipment segment, particularly the aerial platforms. Can you expand on that? And is that a particularly cyclical business? And, if things don't go the way you plan, do we continue to see that business stagnate or even continue to decline?
All right. So yeah, as we mentioned, the access equipment segment mainly targets the construction market. As we know, during COVID and during the pandemic, there has been lockdowns. Construction was not as active. The global construction market fell by 2.7%. So after COVID, after the pandemic started, like the risks of a pandemic started mitigating, economies are reopening. We saw great strong backlog on the access equipment. Their strong backlog right now guarantees demand and revenue stream for the company for the next year. It shows how much construction companies are interested in the products of Oshkosh and how Oshkosh is responding well to the pandemic.
Yeah, and Carlton, if I may add something as well, even though we're seeing this huge increase in demand in the access equipment sector, in our forecast, given we know that they're still facing supply chain issues, on 2019 they had a record revenue in the access equipment segment, and in our forecast we're just assuming that on 2023 the access equipment revenue will recover to the 2019 level. So we're being conservative in regards to that, since there's no right way to predict how the construction industry, given their cyclical nature, is going to go. So we're being conservative on that. After 2023, we assume that revenue begins to improve, but they're still recovering because they saw a huge decline on 2020 in the access equipment sector.
Is there any potential infrastructure spending, if that is passed, in your numbers?
We didn't estimate any potential infrastructure, but obviously we have the infrastructure plan right now going on that could help that. I also read an article saying that as of the first half of 2021, there was a record of square feet under construction. I think that the delays because of supply chain and everything, the lack of materials. So we believe that for the past year and a half, things are going to go better for the access equipment. They will be able to recover.
One last question on another subject. Your WACC seems particularly high at 10.4%. Can you tell us how you got to that number? Yes,
pretty much the WACC, right? We since the company has such a low debt to equity ratio, they have such a low debt. Most of the WACC came from the CAPM. We got a CAPM, I think, at 11-ish%. Something like that. Yeah, we got a CAPM at around 11-ish%, and I think 85% of this weight was from the equity. And then for from the debt side, we just got the weighted average from the 10K of their outstanding debt. They have a 2028 note and a 2030 note, as well as a senior unsecured loan. And we got that to 3.4% for the cost of that. And then doing both weights, the equity weight and the debt weight, we got to the 10.4 WACC.
Thank you.
You talked about the fact that there's been a sell-off in the stock, and everybody's experiencing supply chain issues. So I wouldn't put too much on that. I think that's baked in. And I'm wondering why else there's a sell-off. And related to that, then, if we look at your discounted cash flow, did you assume they're going to get the contracts that are still not for sure, and that the contracts they got are going to pay off as fast as they hope, like for the post office? Or did you dial that back a little bit to be conservative?
All right. So talking firstly about the contracts, in our DCF model, we were being extra conservative because we still don't know how the contracts are going to act out. So we didn't reach their full potential, and we are still adhering the supply chain issue. So we still didn't realize the full amount of revenue or any future unsigned contracts yet. Going to their sell-off, Oshkosh, because of supply chain issues, downgraded their consensus for the last quarter. That is why there was a recent sell-off as well. It was due to supply chain issues, and as well as the construction and heavy machinery market in all being affected by the supply chain arising issues.
Yeah, and I'm sorry.
Now, related to that, you mentioned that each of their business units has a lot of competition. but you didn't talk about who that was or how strong they are. How is their competition doing? Are they experiencing the same supply chain issues? Are they having the same issues with future contracts?
Yeah, I would say in terms of its competitors, they are also facing supply chain issues as the broader market is in general. This has not caused them. This has not caused many of them to see a large sell-off, and I think this is largely due to Oshkosh's. As Omar said, for the last quarter, they missed the revenue estimate by 100 million, and they also had to revise their fourth quarter estimates to make it lower due to these supply chain issues. But as we previously explained, Oshkosh's strong growth prospects and strong balance sheet will help it to push through this supply chain period, and as well as its strong backlog growth. It will help it achieve strong revenues as supply chain issues dissipate into the future.
Yeah, I mean, I'm not that concerned about the supply chain because I think that'll fix itself. You know, you got all these boats sitting in LA Harbor waiting to unload. That'll all be cleared up. I'm more concerned about how strong their contracts are in the future with the federal government and whether you've taken that risk into account. It sounds like you have, but that would be my concern.
They have like we explained before, they have a very well-established relationship with the U.S. government over 90 plus years, and on that chart showing that they got roughly 66% of the total active tactical wheeled vehicles contracts between 2015 and 2020. So that shows that they are heavily favored by the U.S. government in receiving these contracts. So we believe that well-established relationship, along with their over 1,000 active patents and their strong patented technologies, should really help them secure future contracts, which will drive revenue growth.
If I may add one thing as well in terms of the DCF, I don't know if it was that clear during the pitch, but the JLTV contract, the 20-year with expected value of 30 billion, we didn't incorporate that to the model since it would be too much speculation. The only one that we incorporated in some of our cash flows is the USPS, which they are expected to start delivering in 2023. And basically our forecast for the 2021 cash flow, we already incorporated the 3 quarters because they already reported it. So it's just a forecast for the 4th quarter, which we used their guidance updated from, I think, 2 weeks ago to arrive at the financial results for 2021, basically.
Okay, so it sounds like you did the right things. It sounds very good in terms of the way you were conservative where you needed to be. I wouldn't be too concerned about your WACC being too high. I think actually, given the uncertainty, you could argue it's too low, but we'll just let the numbers speak for themselves. Thanks.
Thank you.
I noticed that even before 2020, their net profit growth was not consistent over the last 10 years. I wonder if you have an explanation for that or why you're not concerned about that.
Well, I would say that it varies. It varies so much due to the different contracts they receive. So in some years, they may receive a very lucrative contract, and that might drive revenue growth up substantially. And then in other years or a period of years, they might not get like a new contract. So those periods would show lower revenues than those other periods.
Yeah, and also I think one of the things that that they're taking initiative that might help them in the future is their electrification initiatives, with the first fire truck fully electric, with the hybrid ARFF vehicle, the airport rescue firefighting. So those things should add, especially now with the Biden administration, with the demand for zero carbon emission rising up. If they're able to successfully implement that, they're doing acquisitions. We see that they make acquisitions, they get the intellectual property of those acquisitions and try to implement into their other businesses. So we believe that from now on, after the recovery from the excess equipment, they'll be able to grow in a consistent way rather than what was seen the past years.
In addition, to answer your questions related to operation margin, if we see before the pandemic hit, they had an escalating operating margin, profit margin, till it reached, I think, approximately 18%. With their current debt situation and our projections on the way they're going to pay their debt from their 10K actual facts on how they're going to pay their debt. When the debt matures, we expect operating margin to go back escalating again.
Hey guys, can you hear me?
Yes.
Great. Thanks for the time. Number one, I know there's been a few questions about the WACC, so just a word to the wise. Another way, because the CAPM can kind of be screwy sometimes, to come up with a good WACC would be to take the earnings yield. So if you just look at the out year as a yield on the cost, which right now would be it's about 6.8%, 7%, which sounds more accurate for an equity cost of capital. As far as my questions, without beating a dead horse here on the contracts and the supply chain bottlenecks. So talk about the contracts as far as what are the expirations, this backlog that's there, how much of that could potentially not be captured because they can't actually get to these contracts in time, and what's the price elasticity of these contracts? This is a very low margin business. I mean, from what I'm seeing, high single digits. So they can't really take on too much of a higher cost without passing it on to the customer. So just curious as to how much movement there is in those contracts on the price. And what's management saying about these supply chain bottlenecks? When do they expect them to loosen up? And did you get a chance to talk to them yourselves? Because they have a better view into these supply chains than we do. So just curious as to what they're saying.
Yes. So to start your question in terms of the backlog on the 10K, they state that on the 10Q actually, 68% of their total backlog is not expected to be realized in 2021. As for the structure of the contracts, most of them are fixed price contracts that they do. They mentioned that there is a risk that the government may cancel, given they're doing contracts with the government, they have this power to cancel, but 90+ year relationship, they have been, there's also another contract here that we didn't mention because of the length of the presentation. They were awarded an extension of one of their existing contracts. So we can see from the history of their contracts that the government is very happy with their service, with their vehicles. And then the other part of the question in terms of the management.
Any commentary from them?
Yes, so they were saying, I think for the first half of 22.
Yeah, second half. So yeah, the management believes that the supply chain issues will continue to affect them until the second half of 2022. And what they've done in the last few months, as I explained in the presentation, is they've been increasing the prices of their products to offset these higher costs due to supply chain and to also improve their margins. But they don't expect those costs, that price increase to begin covering those costs until the second half of 2022 due to the supply chain.
Yes, and as for the price elasticity, so they don't mention exactly on, like, they have a couple of contracts such as the USPS that has a range 50,000 to 165,000. For those, the maximum expected value is 6 billion. For the others one, they just mentioned the value of the contract. They don't mention in terms of that. So I wouldn't know how to answer if you. I can look it up later and reach out.
All right. Thank you, Oshkosh.
Thank
we
you.
have to keep the presentation aflow. So thank you very much for your presentation. And thank you everyone for your questions. We'll move to the next team. As they're getting their slides up on the screen, I want to remind you that there is a ballot link. You can fill out the ballot as the presentation goes or at the end of the presentation. And every single vote of viewers will count, helping us manage our fund. And our success certainly couldn't have been this much without your help. All right, P-Car, floor is yours.
Thank you. Hi everyone, my name is Aaliyah and these are my colleagues Hitali and Julian, and we are going to be presenting P-Car to you guys today. Alright. Thank you. Alrighty. So this is just an overview of what we'll be speaking about with you guys today. So our price target is going to be $117.84. At the current moment, the stock is selling for $85.78 per share. Background. So PACCAR is a Fortune 500 company and is a global technology leader in designing and manufacturing advanced energy-efficient trucks while providing financial services, information technology, and distribution services related to principal business. I'm sure you guys can see some common names that you see everywhere you go, such as the DAF truck, Kentworth, and Peterbilt. These are very common PACCAR brands that are very popular globally. Along with their very popular trucks, they have PACCAR Parts, which is a segment of revenue, Dynacraft, which is under their parts, and PACLease, PACCAR Powertrain, Brandon Carco, Geometric, and PACCAR Financial. All of these PACCAR Parts, PACCAR Financial, and the trucks all are part of revenue segments. So our revenue streams. We broke down revenue to 4 main areas, and the 3 ones that I really want to focus on are the trucks, parts, and financial services. Trucks obviously taking up the most share, while parts coming in second, and financial services coming in third. The truck segment has been growing steadily within the last 5 years, along with parts and financial growth services, where we found parts and financial services growing a lot faster. Global highlights on PACCAR. So the US and Canada Class 8 retail sales market share grew to 30% this year. PACCAR Mexico grew heavy duty market share to 36.1%. The DAF introduced a new generation of Euro 3 and Euro 5 trucks in Africa and the Middle East, which is a huge initiative that PACCAR has taken on, is to expand globally, especially in the Middle East. 465,000 vehicles were delivered worldwide in 2020, which is phenomenal for us considering where we were with the pandemic. US and Canada Class 8 retail sales market share is 22%. This is the revenue over the years. So as you guys can see, between 2016 and 2019, revenue was growing at a steady pace. Obviously, with the pandemic, we saw growth of the revenue go down, but we do expect it to go back up to a normal rate. This is just a substantiation as to why we believe PACCAR is valuable to us, because they're able to grow in revenue at steady pace, and we expect it to do the same thing once recovering from the pandemic. This is our SWOT analysis that I want to just give you a general overview of. We believe the strengths of PACCAR are the high steady barriers to entry into the industry. Loyal customer base. When people choose PACCAR, they understand how PACCAR quality is phenomenal and unparalleled, and they believe that once sticking with PACCAR, many of them stay with PACCAR. There are medium imports, low capital requirements, and investing in cleaner technology is one of the biggest initiatives that PACCAR has undertaken, which we will see with one of their contracts with the autonomous trucks with Aurora and FedEx. Their weaknesses are high products and service concentration and high volatility due to the cyclical industry that they are in. Opportunities are new regulation increases and the scope of electric truck production, high revenue growth, and high performance drivers. And we believe the threats to PACCAR are industry globalization, potential increase in costs due to the supply shortages, which stated previously, obviously, everyone is going through a different type of supply chain shortage, and PACCAR is feeling that with the semiconductors. And now I'm going to pass it on to my teammate Hatali.
Hello everyone, I'm here to tell you why we are bullish on PACCAR. The number one reason is the rollout of zero emission trucks. Currently, 74% of freight in United States is moved by trucks. And on the other hand, 18% of the carbon emission come from the trucking industry. Now there has to be a transformation in this sector to achieve President Biden's goal of having zero net carbon economy by 2030. So here is PACCAR. PACCAR is collaborating with Toyota North America to make battery electric trucks, which will be efficient as well as environment friendly. And with the rollout of infrastructure bill, PACCAR is supposed to receive a lot of cost savings as well as increase its customer base. The next phenomenal thing which PACCAR did in 2020 was it improved its fuel economy in trucks by 10 and 7%. In driving truck, the main cost is the fuel. And when it improves it, it really attracts more customers. Next point we have is that the PACCAR is a technology leader. Recently, PACCAR collaborated with Aurora Technology to build autonomous driving vehicles. PACCAR will be the first company to launch its Class 8 autonomous driving vehicle in 2023, and it will be launching with Level 4 autonomous driving systems. The other thing we have is that it is also using a lot of technology strategies for its cost operations. Here we can see the picture of a PACCAR quality process. So they use hollow lenses to make the quality assessment that improves the productivity as well as saves a lot of time in production. Next point we have is the rise in manufacturing sector. In last year, there is a great demand, and due to great demand, there is increase in export and import activities, and this increases the use of truck. Here we can see in the graph that the PMI index rose to 32% in a single year, which is the highest in the US history. Next we have is the corporate strategy. How is PACCAR going to achieve all its goals? First is global expansion. PACCAR is expanding in itself in developing countries. As Alia mentioned, it removed new trucks in Middle East as well as Africa, and it is also expanding in China as well as India. Next is development of strategic partnership for creating electric infrastructure. So as we all believe, the future is EV, and therefore we need battery charging stations as well as battery management systems to have efficient EV vehicles. It has collaborated with Fiat Technology to create battery charging points for PACCAR. Next we have is maintain customer base by providing premium aftermarket parts. So as the population of PACCAR truck grows in the market, it provides premium aftermarket parts such that the vehicle can be maintained for a long period of time. The next we have is the capital allocation strategy. The first is PACCAR is a 100-year-old company, and it has been listed on the stock market from around 80 years. And every single year, it has produced positive net income and regular dividends for its shareholders. Next, we have it has 4.4 billion in cash, which ensures that it can utilize the money to capture any growth opportunity. Next, we have is that it has A1 credit rating, which provides access to low-cost debt, which can be used for liquidity and operating needs. Thank you so much. And now my colleague Julian will continue and explain you how PACCAR will achieve its intrinsic value.
Now I'm going to talk about our revenue and EPS forecast. So we expect revenue and EPS both to partially recover from 2020. And in 2022, we expect it to almost completely recover from 2019, which was pre-COVID levels. And we used our two-price target model. We used a discounted cash flow, a PE analysis, our EV/EBITDA, and our EV revenue analysis to come to a target price of 117.984. That's our target price, and we use a 70% weight on our discounted cash flow model because we think it's our most accurate model of all of them. Here we have our PE model. We use the current PE ratio for PACCAR to predict our EV, our EV calculation, and that's how we reach our 108 price target for PE, and same for EV revenue of 126. That's how we reach our 2022 price targets. Then we have our ratios and margins. We divide them by valuation. We have our PE of 17, prices of 1.6, and price to book of 2.88, and EV/EBITDA 13.94, EV sales 1.91, and same for efficiency. We divide them by revenue per employee. Then for liquidity, current ratio of 1, which means that they are able to meet their current liabilities with their current debt, with their current assets. And we have profitability and capital structure. And all these ratios mean anything unless they are compared to their competitors, of course. That's why we have our graph here. We compare PACCAR to the global competitors in terms of operating margin. PACCAR has remained on top since 2012 in terms of operating margin. And this means that they are able to profitability, like they remain on top, even in terms of the pandemic. All of them, as you can see, profitability has gone down, but PACCAR has remained on top. More of a detailed explanation These are different competitors, but these are more of US listed stocks. Um, Same thing, Packard has remained not as high as its own, but almost in like average. Meritor, GM, and Volvo prices, price book, Packard has remained almost as average in terms of valuation. Profitability, same thing. Packard has remained like almost on average level, not as high as Eaton, but higher than Meritor, GM, and Volvo. In terms of debt to equity, their capital structure is almost 1-to-1, so they organize the debt to equity in a way that debt to equity is more 1-to-1, which is a good thing, we believe of. Now I'm going to explain the risk, the key risk we expect for Packard. There are many risks for any company, but for Packard we expect like production and with the current supply chain issues, Packard, the financial results have been affected in 2020, but we expect them to partially recover in 2020 and to almost completely recover in 2021. And this is because supply costs are higher, and also like their suppliers, they are not able to meet the demand. Then we have commercial and track demand is variable. This is because it's more sensitive than national and global economy, like for the heavy trucks. It's more sensitive than the global economy and the national economy. So that's one risk for Packard, that their trucks are more sensitive to the demand. And then we have competition and pricing, like every company, they have competition, but with EV vehicles coming in the industry, that's like a heavy competition, but we believe Packard has been doing like their strength, and they've been doing since 2017. They have been investing in electric vehicles, but it's also a heavy competitive area, so that's why we believe it's another risk. We're moving on to Alia. She will come with the conclusions for Packard.
Hi again. So in conclusion, we believe that the key drivers to growth are going to be the zero emission trucks, and that's with their contract that they've already signed with Aurora and FedEx, where in the future we believe they will be having energy and autonomous trucks. We also believe that the expansion in developing countries such as the Middle East and Africa will be expanding growth in the long term. We believe that it's a technology leader in comparison to its competitors, and strong operating cash flows is something that we've seen consistent within the last couple of years. And it has an A1 credit rating, meaning the cost of getting debt is very not expensive. In our view, Packard is an undervalued stock, and its intrinsic value is 117.84 cents within our valuation. And moving on to questions.
Hey, it's Clinton, and thank you for your presentation. I think my question is, I get the electric vehicle play, and I get that might be a bit more longer term, say call it 5 or 10 years. I look in the kind of the 12 to 24 months out, I think there's two things, and they're kind of intertwined coincidentally. One's driving demand and one's actually constraining it, and that's supply chain. If you look at their delivery, they were going to do 33,000 next quarter instead of 40,000 they expected. And then you look at the overall demand for trucks right now, it's elevated due to the supply chain, due to trucking rates, driving that demand. But if you think about it, do you think this is an aberration in a long-term trend, and that you're going to see orders canceled, given that they're at what would be considered historically high levels? But how do you consider that kind of playing into your calculus as an investment thesis, maybe in the more short term, in the 2 to 3 year time frame versus the 5 to 10 in the electric play? Thank you.
So we believe that they are accumulating demand. So all the demand that is because of the supply chain issues, all the demand has been accumulating. So that's why we expect like higher demand in 2021 and 2022, and same for the rest of the years. We expect the supply chain issues to be solved, and that's why we expect a higher demand in those years and to recover from 2020. Yeah, that's what.
But if the supply chain issues are addressed, right, then your trucking rates are going to go down. So the demand for them is going to be inverse, right? So they'll be able to fulfill orders, but their demand, they'll be the backlogs and canceled. I guess how the trend of backlogs, how has that trended for them in terms of bookings? And then was that in part of your calculus as you thought about kind of the go forward plan? How did that play into your thoughts?
So currently there is supply chain issue and the prices are high, but the retail sector is expected to grow at 7.7%. And as the retail sector and the e-commerce activities expands, the demand of truck will go on. And as people are working remotely, they're expanding to different parts of the country. And this increases the demand of trucks and transportation.
And to add on to that, like Hatali said earlier, 74 of the economy is boosted by freight and is supported by what we do and what our industry lies in. And we do believe that not only is that percentage going to grow in the future because we have become so reliant to transportation through trucks, we believe that PACCAR will be still the choice and will still be able to provide with lower costs as they move into autonomous trucks.
Thank you. And then just one final one for me. I guess this is a bit more of an ignorant question coming from somebody not in the industrial industry. But how does intermodal play with this, right? So train versus truck. Are people using trucks, which are a higher cost option for long distance hauling due to capacity issues currently in intermodal? Or is that really something that we should be thinking about as potential investors in this company?
If I'm understanding your question correctly, you're saying why do we believe that trucks will be chosen over trains?
No, I guess does intermodal transportation and the current kind of trucking rates environment, is that distorting demand possibly as well, or is that something that you guys looked at? It might not be important, right? I don't know. So I'm looking to you guys for guidance in terms of how you think about it.
Yeah, totally. Well, I don't think we did look at the intermodal segment of it, but we could definitely look into it more and see how it will have an impact and an effect in the long term on the economy and with PACCAR involved in it, and we can get back to you on it.
Perfect. Thank you so much for your time and great presentation.
Thank you.
Hi, I was trying to look back at your SWOT analysis to see how much your cash flow is dependent on it, but it's not in the book, or at least I couldn't find it in the book. So could you put it back up on the screen?
Absolutely. Do you want the cash flow on
The
this?
SWOT.
Do you want the SWOT. Okay.
Okay, because it disappeared. Yeah, because what I'm concerned about is the dependence on the EV, because we all talk about that and everybody would like to reduce the carbon footprint, but as the previous questioner mentioned, it's really further in the future than you might think. And I want to be sure, when I looked at your financials, you showed revenue growing very fast. You showed profits growing faster every year. How much of that is really tied to the quick adoption of EV?
So we believe that the EV adoption is like a progression. It won't happen from one day to the other, but PACCAR has definitely been, since 2017, they've been adopted, like talking to other EV companies to produce their EV vehicles and parts. So that's why we believe that they've been like adopting like to the EV progression. And that's why we believe like they are adapting to the future and to the customer demands and what the future like is what they demand, right?
And
Well, it's good that they're adopting, but the question is, will the people who buy the trucks want EV as soon as they're hoping they will?
Well, we do believe that PACCAR is ahead of its time, which we think is a positive thing that it is, and that they are able to provide what the transition in the economy is going to need 10 years from now. So rather than us predicting that 10 years from now that EV is going to be the essentials, PACCAR is adopting it right now, going into the transformation as of now, so they don't have to do it 10 years from now where there's going to be a higher cost for them to do it. Rather, if they adopt it right now, transition it and implement it to their customers, they're able to get that adoption a lot quicker for the long term.
And as the regulations,
Customers don't want it. Are they still building trucks with internal combustion engines that they can sell?
I believe so.
Yeah, they are, because there's still a demand to meet. Internal combustion engines are not completely gone, but they are like progressively like going to electric vehicles, but not like from one day to the other. Like they can completely go from combustion engines to electric vehicles. So they are progressively like going. But this has been a process from the last like 4 years that they adopted. So they are going from slowly, like steady, going to electric vehicles to adapt to the current demand, which is in the future electric vehicles are going to dominate the automotive market, right?
Okay, that's good. I don't want to be on the road when one of these 18-wheeler autonomous vehicles comes along. So let me know when that's going to be.
Very optimistic in their progress with the autonomous vehicles, and especially in the fact that it's not going to be on the road within the next year or two, but it will be there within 5 years. And we believe that's going to cut costs in the long term. So we have a very optimistic approach when it comes to being able to bring in more profit, because that cost area on the income statement will be lower due to the they're going to be removing the cost of employment, since autonomous trucks will be taking over that in the long term. So even though they might be scary on the road, they'll still be very nice.
They'll be making movies about that. Thank you.
Let's hope not.
This is Sam Darkhatch. Can you hear me okay?
Yep,
Yeah,
we can hear you.
Hi, and terrific presentation. Thank you for all the work that went into it. It was very apparent that you went through a lot of pencils. Your target price obviously suggests that there might be as much as 40% or so upside, which implies that the market's really wrong with where it's pricing the stock right now. First question would be, where are your forecasts versus broad expectations? Is your call that the estimates out there are too low, or is your call that the valuation is too low? What is specifically your edge in this, in your thesis?
So we are particularly bullish that the market will soon recover from the supply chain issue, and there will be higher demand for the EV trucks as well as their hybrid trucks. So based on that, we forecasted, our forecast is of like 6% at perpetuity. So that drives our forecast. We think that the market is undermining the supply chain issue, and they think that it will take a longer time. But we think that supply chain issues should be tackled by the middle of 2022, and there should be free flow of semiconductor chips.
Okay, so if I'm understanding you, you're saying that street estimates are too low, at least for the next 2, 3, 4 years, and your forecasts are meaningfully above those expectations. Have you double checked that to make sure?
Not so much above, like we're about in line with the expectations for 2022. The things that the supply chain issue is affecting many, like our industry and many companies. So we expect like our company is going to recover, especially being a market leader in this heavy manufacturing sector. It's going to stand higher than the other companies, and it's going to recover well in 2022. That's why we think like Packard is like a strong company to invest in right now, that is being affected by the supply chain issues, but it's going to recover well in this next year and next 2 years.
Gotcha. And my last question, the valuation really bounces around a lot. I mean, just the last 5 years or so, the price to sales has gone from, let's say, 1 to 1.5. EBITDA has gone from like 9 to 18. It's crazy the vacillations in valuation. Have you figured out why or what the market values with this company? When does this stock get a rich valuation? When does it get a cheap valuation? And why are you comfortable with your price target, and that it's going to be, you're basically saying, hey, this thing is worth not only at its peak, even more richer than it's valued today. Why? How do you feel comfortable with that with such a cyclical issue?
So to start off with, we do believe that where it is bouncing off with a higher valuation versus a lower valuation is imperative upon what the industry itself is doing. And since we are located within a very cyclical industry that has a lot of pent up demand now, we do have expectations for the future for it to be more of a high valuation rather than where it's at right now. And that would be our dependent variable on why there is lots of volatility, I guess, within whether it is being valuated highly or lowly. It's dependent upon where the industry lies within the economy, since it is very cyclical. If you guys would like to add anything else onto that.
Great, thank you.
Of course, thank you.
Just a quick one from me.
Again, guys.
Oh, I'm sorry. Go ahead.
Sorry, just had sort of a more generic question. I do like the ideas that both groups have come up with. Was there a theme? Was there something that led you guys to looking at these plays of companies that would recover faster than others in this scenario, that were probably cyclical but have, you know, very strong competitive advantages? Was there a thinking that went into this, or was this just a random choice?
Well, on my side of things, the way I thought about it is in the most common and basic way is what has the demand created the most? It's online shopping. And how is online shopping being taken out? It's through trucks. And so we believe that that's just a small thing that led to a bigger theme. And on our side, we just saw that, okay, there's so much pent up demand from the pandemic and we could see this growing in the long term. And for that specific reason that led to several other reasons, we came to this point.
And we also looked at that the supply chain issue people are seeing as a very long-term trend, and the stocks are losing value due to that. And we also saw that the upcoming trend is EV, and this company had low PE ratio in compared to its competitors, so we selected this company.
Thanks, guys. Like the thinking.
Thank you.
And that takes me to my question on the EV part. Did you look into whether it made more sense to do the EV in-house or to go out and acquire a company that already has maybe progressed further in the technology? It sounds like it's one of the key catalysts or drivers for going forward. And just thinking about the time, you know, we talked about 5-year period here. Would it be worth it to just buy somebody else out who's further along and pay the price today? I mean, they have a pretty strong currency. The multiples, arguably the highest in the industry. So I'm just wondering if it just makes more sense to take advantage of that strong currency and just get ahead of the game here.
Yeah, so it really makes sense to outsource the EV platform by Aurora Technology. So EV requires a lot of research, and Aurora is doing the research, I think, from past 10 years, and it has bought a unit from Uber. So it really gives us a competitive advantage in the market in the EV segment. So we think that PACCAR has taken the right decision to collaborate with Aurora and remove its autonomous trucks.
Thank you.
That will be our last question for you guys, and thank you for Carl, did a good job. And Carl, turn to answer your question. Our theme is always how to make money when you sleep. That's our ASA model. And the next stock is Alibaba. It's only less than 2% of our portfolio, but don't let that fool you. We've had extensive conversations about this stock for a long time. So let's hear from the students.
Okay, hello everyone. Thank you for joining us today. My name is Tyler Kilma. This is Umang Patel, and this is Sam Misio, and the sell we are pitching you today is Alibaba. So first we're going to take a look at the intrinsic value that we calculated. Using our DCF, we have Alibaba currently at a price of around $149, and on the next couple slides we're going to get into why we believe it should be at this price. So first, we're going to look at why sell now. So the company is facing supply chain issues just like a majority of the rest of the companies in the market, and this is resulting in an increasing cost of goods sold. Now, although their revenue is increasing as well, which would also increase their cost of goods sold, the rate at which their cost of goods sold are increasing is faster than their revenue is increasing, resulting in lower margins. Another reason why we believe now is the right time is they've had a consistent drop in market share in each of their major business sectors. So Alibaba has over 80% of their revenues coming from their e-commerce section, as well as cloud computing being their second highest area. the reason their market share is decreasing is because their competitors have had, these are two competitors have had increases in market share, as well as many new companies entering the market and stealing market share from Alibaba. Another reason is the Chinese regulatory crackdowns, which are potentially devastating to the stock, which Sam will talk about a little bit later on, talking about some of the governmental factors that are impacting Alibaba. There is also a probability that Alibaba may be delisted within the US stock market within the next 5 years, which is again one of those governmental actions that Sam is going to touch on. Another factor is that China has been experiencing surprising economic troubles, as shown with the Evergrande crisis, and we think that this may impact not only Alibaba, but many of the other Chinese stocks that we could potentially invest in, and that's why we think this is a good time for Alibaba to be sold. And the last point is, if we look at the chart here, during the first year we held Alibaba, we can see that it was in line with the S&P. It was increasing, had some nice growth. But in the second year, it has consistently decreased and even dropped below our purchase price, and is sitting just around the purchase price that we had now. So we think now is a good time to sell while we can get out while we're just ahead, as opposed to potentially taking even greater losses. So now I'm going to talk about some of the catalysts that are from what happened, why we decided to invest, and where Alibaba is at with its current state. So pre-investment, they were talking about their expansion into Southeast Asia, the Middle East, and Northern Africa. They had relatively nice success in that area. However, they failed expansion in the US. And the US is the second largest e-commerce market in the world. And they couldn't succeed here, which if they were relying on those revenues, that's not a good sign for Alibaba in terms of overall growth. Another pro for pre-investment was they had strong revenues in their cloud services area, with increasing margins by 20% in 2019. Again, going back to what I said on the previous slide, with their increasing or their decreasing market share in that area, it's actually decreasing their margins in that area as well. And third, their market share, they had strong market share in core commerce and cloud computing, and although they do still hold a majority of the market in those areas, it is quickly decreasing because of their competitors growing their market and new competitors entering the market. Some other negatives that are currently facing Alibaba, again, are those regulatory crackdowns on tech companies, which have already hurt companies such as Didi and Tencent, and their non-compliance with US audit regulations, which can lead to their potential delisting in the near future. I'm now going to pass it off to Umang, who is going to talk about their decreasing market share.
Thank you, Tyler. So as you can see here, this is the core commerce market share. And so these are the major players involved in the China market. On the left, it shows our market share during the time of investment back in 2019. And so I'm not sure if you can read the key too hard, but the orange is Alibaba, and the major players such as the gray and the green, those are JD.com, and as well as the other basic culmination of major other companies that are starting up. And then moving to 2021, you can see that the orange has definitely gone down roughly 9%, and with JD increasing a little bit, but the major one is Pinduoduo, increasing almost double from 7.30% to 13.20. And like Tyler mentioned, core commerce makes up roughly 86% of total revenue streams of Alibaba's total revenues. And so, with this decreased trend, it is a larger risk when it comes to the overall profits. And so that is something to look at. Moving on to our second biggest revenue stream of cloud computing. Although it is roughly about 12% of total revenue, it is an increasing industry, especially in China. It is estimated to increase total industry numbers ahead of the US by 2024. But unfortunately, with major players coming in like Huawei and Tencent, it is a bit risky to continue following Alibaba with these other major trends. So one thing I want to point out is with Baidu AI Cloud, it grew 49% in market share year over year. And so, it'll be interesting to continue to look at these other major players in the industry. And one thing I really want to point out is Alibaba decreased 8% year over year in market share. And I think we'll continue to see that trend in the coming years. Now I'll pass it off to Sam, who will talk about the valuation.
Thanks, Umang. We have several important ratios that we factored into our valuation. Return on equity, you can see up here, has been decreasing, and we project it will continue to decrease. Revenue growth, was very high in fiscal year 2021, but we're projecting that that's going to go down significantly and get back toward pre-pandemic levels, and then it's going to decline. Profit margin has been declining, and we expect it's not going to decline as much after 2022, but still going to decline. And gross margin has been declining for a long time, and we don't see that slowing down. Some other important issues with Alibaba are the regulatory issues and the issues regarding the stock's delistation. So the Holding Foreign Companies Accountable Act, which was passed almost unanimously, requires an inspection by U.S. auditors of foreign companies traded on U.S. exchanges. And if these companies do not comply, they will be delisted within 3 years. The problem for Alibaba is that Chinese law does not allow for this audit to be done. So essentially, it just produces an imminent delisting for Alibaba. Another issue with the Chinese government has been the regulatory crackdowns. DD Global and Tencent Holdings have been particularly impacted by this, and it's potential that there could be even more. Now, the delisting in particular, U.S. investors are not going to want to invest in a stock that's going to be delisted soon. So that's a major reason why we think now is the time to sell well before the delisting. And now we're on to Q&A.
I have a question. You said that the Chinese law will not allow Alibaba to be audited. So does that mean that all Chinese companies are going to be delisted?
They could be delisted depending on if they stay in China and comply with the law. It's very likely that they will be by 2024.
What are you basing your probabilities when you say likely? And, going back to, I think, this prior question, on one of your earlier slides, you kind of pointed to something like a comparison with Tencent being more positive upside more recently. So are you suggesting that you would look at these other China tech to replace this with? So how do you kind of reconcile that story?
Well, we were discussing Tencent and DD in the context that their stock prices have been severely hurt by the regulatory crackdowns. Now, as far as our probability of delisting, the SEC has said that the clock is ticking on these stocks, and they are set to be delisted in 2024 unless something major changes. And we have not seen any indication from China that they're going to allow this to happen, for the audits to happen.
So you think Alibaba is going to potentially not comply, even though a majority, or at least about 40% of their ownership is by institutional investors in the US?
If it stays in China, unless it were to, for example, move its headquarters completely out of China, it would most likely comply with the law, or it would have to face whatever consequences would come from the Chinese government.
My last question is, do you think all of this is already priced in? Is now really the time to sell? And again, what would you and I know you might not have an answer to this, but you kind of compared it with the S&P 500 and you're looking at that relative performance, but that's not your opportunity set, obviously, because you hold this stock. So how is it performed relative to kind of other, not just Chinese tech stocks, but just the MSCI ACWI index, for example?
When we were looking at our comparisons, we did not actually look at that index. So I could edit and get back to you in terms of that specific comparison. However, overall, I think now would be the time to get out because of where it's sitting at in relation to our purchase price, right? If we had sold it a year ago when it was at the high during our holding, then obviously that would have been ideal. However, based on its current trend of where its stock price is going, we think it's going to continue to go down. So while it's currently sitting just above the price at which we purchased at, I think now is the best time for us to get out without accumulating major losses and even making a slight little bit of gain on it.
Okay, great, thank you.
I'm going to go ahead and jump in with a question here, guys. Good presentation. A contrarian would say you should double the weight in the portfolio at this point. So here's a theoretical question. If you're selling this, are you short or negative on Amazon? I think these guys are probably in a better business. They have better margins, better return on capital, their net cash, and they're cheaper on multiple metrics. And so if you're selling them, logic would argue would be short or negative on Amazon. Correct.
So the difference between Amazon and Alibaba is it goes back to this delisting possibility of they're in the Chinese market, as well as they couldn't get into the U.S. market, like I mentioned earlier. They tried getting into the United States market, and I thought they were frozen for a second. Sorry. They tried to get into the U.S. market where Amazon is thriving, right, with the whole pandemic and people buying online and all of these things, where Alibaba is currently dealing with the Chinese government not allowing them to comply with the SEC audit that Sam was referring to. So that is why we're selling Alibaba, not necessarily talking about Alibaba comparison to Amazon, because Amazon isn't going through these problems that Alibaba is.
Is Amazon thriving in China?
I could look into it and get back to you on it, but I don't know Amazon's current state in China.
Okay.
The charts you showed with all these declining lines that look terrible, were they numbers provided by the company or by some sort of independent body?
So the previous numbers that we got, those were from SEC filings, and then the later on numbers on those graphs were part of our forecast. So the beginning parts of those graphs were their numbers, and then the ending was our forecast based on some of their numbers and other factors that we included.
And also based on our revenue build, I believe we were somewhat conservative because we were right on with the overall consensus based on from analyst estimates.
Because you know the stock's gone up a lot in the last few weeks.
In the last day, we saw really good activity. It went up 4%, but in the last week, we did see, I would say, a stable trend.
Yeah, I think they'll make a deal. They won't get delisted, but I'm not sure I trust their numbers even after they make a deal. So I'm certainly okay with selling it now.
Okay. If no further questions, then we'll conclude our Alibaba pitch here. Thank you, Team 3. All right, everyone. That is all of our first pitch today. Thank you very much for joining us. We wish you a great week, and please don't forget to cast your ballot online. You can do so by following the link in the email. If you have any questions or comments, please feel free to write them down in the ballot. And again, thank you for your time. I look forward to seeing you in November. Have a good one. Bye-bye.
Thank you.